This video was made possible thanks to Enquiries AI. More details coming up soon. Is the United States about to enter an economic recession? I know it may seem like a typical sensationalist question, but it's not. Since last week, many analysts have been suggesting that the US economy is on the verge of derailing, and fears have skyrocketed since the US stock market plunged last Monday.
Wall Street tumbles over fears of US recession. The US is at real risk of recession, and it's a disaster for Kamala Harris.
The main reason that has led so many economists to pessimism has been the labor market. In the month of July, only 114,000 jobs were created, despite the expected figure of more than 170,000. And yes, it's true, jobs are still being created, but fewer than expected. And the problem is not only what is happening now, but that there is a downward trend that in a few months could push the problems to breaking point. Proof of this is that the unemployment rate has risen for the third consecutive month. That is, more and more people are looking for work, but are unable to find it. What's more, other indicators such as delinquency rates on credit cards and car loans are at their highest levels in more than a decade. Some consumer companies such as Airbnb are struggling because they claim demand in the United States is falling more than expected. And the manufacturing index, which measures the volume of manufacturing activity, and which is usually a good predictor of recessions, has also entered recessionary territory in recent months. The question now is, why? What is it that suddenly makes the US economy seem to be on such a bad track? And remember, I say suddenly, because until a few weeks ago, everything seemed to be going smoothly and at full sail. Peak unemployment levels, peak GDP, Wall Street sky high, and suddenly, bam! It's all bad news, especially since last week where the stock market suffered its worst drop in 2 years. Well, in this video, we're going to tell you what's behind all this, what the real situation of the Yankee economy is, and we'll explain if recession is inevitable. But first, as someone who's been making YouTube videos for a few years now, there's a lot that goes on behind the scenes to make it possible. But I recently came across this tool called Enquiries AI. It's the world's most used AI video creator with over 10 million users across 150 plus countries. It's the only tools that I've tried that puts you in the driver's seat and works as your personal sidekick. But it's better if I show you with an example. Just ask InVideo to create a 3-minute video for YouTube. For example, about how China plans to avoid economic collapse, a topic we talked about a few days ago.
China, a global powerhouse, has been growing at an extraordinary pace for decades, but...
And if something doesn't convince you, you can always edit everything in detail as needed. Just go to the edit command box and type what you need. For example, translate to French and add subtitles. It's that easy. Additionally, you can clone your own voice and make it narrate videos in your own voice in any language. Amazing, right? By clicking the link in the description, the pinned comment, or the QR code on the screen, you can create up to 4 videos for free on InVideo. However, they will have a watermark. For just $20 a month, you get full access. And if you use my code, you will get twice the number of video generation credits in your first month. It's much more affordable than the cost of all the tools separately. Remember, it also includes a vast library of royalty-free material. Thank you very much to Enquiries AI for sponsoring this video, and let's continue with today's content. Has this wave of negativity caught us all by surprise? Well, the answer is no, in fact. Many analysts were already warning that a scenario of slowdown, cooling, or even recession like the one we may be experiencing now was possible. In fact, for a long time, it was the most likely scenario. As early as 2022, many media outlets such as The Times, based on reports from prestigious analysts such as the Goldman Sachs team, pointed to an imminent recession. In 2023, the same thing happened. Here you have Bloomberg warning that recession could come soon. Right now, it would be very easy to criticize these media outlets for failing in their predictions. But firstly, economic analysis is not a crystal ball. And secondly, it was quite reasonable in those days to think that a recession was coming. In fact, practically everyone took it for granted. The reason is that with the huge inflation hikes we are experiencing post-pandemic, the Fed had to raise interest rates. Raising interest rates, especially as drastically as the Fed did, typically triggers a recession. For what reason? Well, because rates are raised to cool down the economy so that people don't borrow money, and thus slow down inflation. With this, it was taken for granted that the economy would go into recession. It was the price to pay to put an end to the escalation of prices. The really surprising thing came when, despite the high rates, the US economy just kept growing, creating jobs, increasing its productivity. In fact, the surprise, the really extraordinary thing, is that there has been no recession so far. Nevertheless, it stands to reason that everything has its limits. Inflation is already quite low. The latest calculations estimate that both headline and core CPI are hovering around 2.5%, when the target is to keep it around 2%. We've already had high interest rates for a long time, and keeping them forever would lead to a recession. This is precisely what explains some negative data, such as the employment figure or the drop in consumption. The fact is that now the economy is finally starting to show some signs of weakness, everyone expected the Fed to cut rates starting in August. Problem? Well, it hasn't.
Fed holds rates steady and notes progress on inflation.
It's been very surprising that the Fed has not lowered rates in the face of signs of weakness, and it will not review them again at least until September. The question is it so alarming not to lower rates now and wait a few months? Well, it seems so. The problem is that economic decline is not linear. That is, things can get ugly very quickly. Economic cycles have behaviors that feed back on each other. In other words, things can go a little wrong today, but very, very quickly, without any warning, they can go from bad to intolerable. Think about it this way. If employment falls and consumption drops, many companies interpret that the economy is on the wrong track. So, as a precaution, they reduce investing, spending, and hiring, which in turn worsens the employment and consumption data, which again creates concerns for more companies and citizens. And it's back to square one. The result? A vicious circle that can feed itself exponentially. The way to stop these spirals of negativity is to offer positive expectations, to give signals that, hey, maybe the employment figure is not the best possible, but you go on with your business and the problems will be resolved. And that's exactly the role of governments. More specifically, in this case, the Federal Reserve, and above all, the expectation that they will lower rates. So what is the problem? Well, they haven't lowered them, and now that spiral of negativity could grow too fast, so that waiting until September may be too late. So, knowing all this, the question is, why on earth hasn't the Fed lowered rates? Do they want to watch the world burn? Well, things are not as straightforward as they look. First of all, there's one thing to keep in mind. The Federal Reserve decided not to lower rates before the employment data was released. It's possible that they would have made a different decision if they'd known about it. But even so, there are good reasons to believe that, in reality, not lowering rates was the right decision. Or did you think that the Fed is run by monkeys with guns? Far from it. Let's be clear, these days the priority is still to reduce inflation. It's true that achieving this is very close, but it would not be the first time that things get out of hand by being too lax. This is a lesson they learned very well in 2021. By not being strict against price increases, the market got out of hand. But on the other hand, what if I told you that it isn't necessary to lower rates to give positive signals to the markets and break those negative spirals? Think of it this way. Controlling inflation is in itself a positive sign. In fact, over the past few years, Wall Street has shown positive responses to rate hikes because they interpreted keeping prices in check as a good thing. But on the other hand, the important thing is not to lower rates, but for everyone to believe that you are going to lower them. Remember, the key is expectations, positive signals that break vicious cycles. And it may seem ironic, but this past week, the markets are acting as if the Fed is going to cut interest rates even further than before. In other words, even though the Fed has not lowered anything, markets now expect that in September, the Fed will lower rates much more than it would have done before. In a way, it's as if in September, the Fed is going to make up for what it hasn't done in this past week. A full-fledged positive signal. I know it's not that the markets are crazy. There are good reasons to believe that this time, September, will be the month of downturns. To begin with, several members of the Federal Reserve, including Jerome Powell, Mary Daly, and Austin Goolsbee, have made one thing very clear. They will do whatever it takes to maintain the stability of US employment. Mary Daly has literally used the expression, whatever it takes, which, as you may know, is Mario Draghi's phrase that saved the euro from falling off a cliff during the financial crisis. And just with Draghi, these messages now evoke security and confidence. And take note, this is not just mere lip service. These are messages that have direct implications for the economy. For example, although official rates have not fallen, the banks themselves are already assuming that, after the bad employment data, they will fall much more in September, and are already offering mortgages with interest rates well below the official rates. The US government itself is also benefiting from this. Interest on 10-year Treasury bonds has dropped 100 basis points in the last 3 months, and investors are now lending to the government at 3.75% interest, even though the official rate is at 5.5%. In other words, the Fed has lowered market rates simply on expectations, without needing to lower them officially. But is it really worth the risk? Can't the Fed take emergency action and lower rates as an exception in the face of bad data? The answer is yes, it could. There's nothing stopping them from turning the rudder tomorrow. But do you know what? It would probably be a lousy idea to do so. If the Fed were to lower rates as a matter of urgency and surprise tomorrow, what signal would it be giving to the world? Trouble! Alert! The situation is getting out of hand. Calm down, everyone. That would be anything but a positive sign, such as the carry trade we discussed in the previous video. It could alter exchange rates in an unforeseen way. Remember, everyone now expects rates to come down in September. And in economics, stability and meeting expectations are often more important than acting quickly and desperately. But even taking all this into account, there's another big problem here that is not being considered. Are the employment data really that bad? Do so many analysts really think that there will be a recession, or has a balloon been inflated without much foundation? For starters, analysts at UBS, the Swiss bank, believe that there will be no recession. In fact, they estimate that the economy will continue to grow at a rate of 2%. At the Atlanta Fed, they have even downgraded their growth expectations. In their latest revision on 6th of August, they have projected GDP growth 0.4 points higher than they had at the beginning of the month. The point is that the US is not doing so bad either. It's true that the job creation data has been weak, but in April it was even worse and then rebounded. The same happened in March of last year. What's more, according to UBS itself, this poor figure could be heavily influenced by Hurricane Beryl, which has meant that more than 400,000 people have been unable to go to work, and therefore many employers have temporarily laid them off until they can resume their jobs. But even with those factors, we have to take into account that the US economy is practically at full employment. Unemployment stands at a ridiculous 4.3%. So what does this mean? Well, when everyone has a job, it's much more complicated to continue creating even more jobs. In fact, a large part of the increase in unemployment is not due to layoffs, but to the fact that many immigrants are arriving in search of jobs and are taking a long time to find them. But even so, creating 100,000 jobs is more than enough to keep the economy humming. So what about consumption and manufacturing activity? At the beginning of the video, we said that these indicators were also suffering. And yes, that's true, but here you have to look at the whole forest and not just a few trees. There are many other indicators that are performing well. Real consumption seems high, despite complaints from some companies. GDP is growing at a good pace, and industrial production is accelerating. The Institute for Supply Management's Index of Service Sector Activity, which was released on Monday, also rose more than expected compared to July. Second quarter corporate earnings, except for certain technology companies, have exceeded expectations, with a projected figure of around 13% above the 9% expected at the beginning of the quarter. Meanwhile, households are in good financial shape. Their wages are growing, and their net worth has increased by 37% since the start of the pandemic. Of course, this does not exempt other data, such as delinquency, from being negative, but it must also be taken into account that, in good times, more people get into debt, and more people are at risk of defaulting, especially in the less favored strata of society. So what is the conclusion? Well, this is not to say that everything is rosy. The data could be better, and the trend is not spectacular. Indeed, as far as employment is concerned, it is negative. But recession is one thing, and deceleration is another. In our opinion, and here everyone will have their own, and it's completely respectable, the US economy is in a slowdown phase. A phase where things are going less and less well, but without necessarily reaching the point of contraction and crisis. If that point is reached, the Fed still has plenty of room to lower rates. It's possible that an explosive downward spiral of negativity could suddenly emerge, and everything could come crashing down extraordinarily fast. But even if this were likely, it doesn't seem to be the most feasible scenario today. And part of the proof of this is that since Tuesday, the US stock market seems to have recovered its normal rate of growth. Let's just say that the Fed's failure to cut rates has caught everyone by surprise. It has thrown expectations out of whack, but there are many steps from there to promising an imminent recession. In any case, once again, this is our opinion, which is why I'm now asking you for yours. What do you think about it? Will there be a recessionary spiral that nobody expects? Or are you more optimistic and believe that the bad omens are not as negative as they seem? You can leave your answers down in the comments. And as always, don't forget that here on Visualeconomik, we release new videos every week. Hit like if you liked the video and subscribe so you don't miss any future ones. All the best, see you soon.